It might not feel like it now, but at some point you'll likely have spare cash, whether it's from a bonus, a tax refund, or savings over time. Once the basics are covered, the big question is, where should you put it to work? Is it better to pay down your mortgage or invest in the share market? Financial advisor Ben Nash from Pivot Wealth joins us. Ben, good to see you again. What do you recommend to your clients?
Well, I think it really depends on the situation that you're in. There's a quick answer, I suppose, and then there's the right answer for most people. The quick answer is found by looking at the interest rate that you're going to save by putting money into your mortgage, and you compare that against the expected return that you would get from investing into the share market. And so at the moment, we're sitting at mortgage interest rates of around 6.5%, and the share market, the long-term return is about 9.8% in Australia over like a 30-year time frame. Now, keep in mind that mortgage interest, especially on your own home, is not tax deductible. And so that's an after-tax return, that's 6.5% saving, whereas the return on the share market is taxable income. And so the after-tax return is probably a little bit lower than the 9.8% headline. But typically, over the long term, it's slightly better from a pure numbers perspective to be investing in the share market. But then you need to look at your strategy and where you're at to figure out what's going to be the best move for you.
How do you figure that out in terms of a strategy for you?
Well, I think you look at how much room you've got in your financial situation overall. And so, for example, if you're a first home buyer and you've just stretched yourself to get into the property market, you probably have a relatively high mortgage, perhaps the highest that it's ever going to be. And maybe your cash flow is quite tight. And so for someone in that situation, putting some extra money into your mortgage can give you a bit of breathing room in your debt. It also can bring your monthly mortgage payments down, so help from a cash flow perspective.
And sleep a bit better.
And sleep a bit better at night. So because you're not carrying so much risk, absolutely. Yeah. Whereas if you're on the other side of that spectrum and you've got a very low mortgage relative to the value of your home, maybe you bought 5, 10, 15 years ago and your cash flow is quite good, then in that sort of case, then perhaps you could look more to invest in the share market because you've got the room to actually do that.
What about putting that extra cash into super?
Well, super's great. It's essentially the same as investing into the share market, except for the fact that you get a full tax deduction on money that you put into your super fund up to that concessional contribution limit, which is $30,000 up to the 30th of June and then $32,500 from the 1st of July. It still does the same thing from a returns perspective, but you get the tax benefit on the way in. The only thing to keep in mind is the access to your super. The money that goes inside, you can't touch it until you're getting close to or in retirement. So if you're younger and you've got a lot of time before that is, then you just want to carefully consider and make sure that you've got some level of assets outside of super and that you're balancing it as part of your overall financial strategy.
There's a strategy for everyone, isn't there? If you think it through. It's how important is it to get advice, even from a young age, to build a blueprint, to talk to an advisor like you?
Well, look, obviously I'm a little bit biased being a financial advisor myself, but I've been fortunate to see thousands of people put together really good financial plans, and you can see the financial upside, the confidence upside, and the peace of mind that comes from that. So I think it's very valuable, but I think particularly with decisions like this, the benefit that you get from seeing everything mapped out. And I think for older people, they're getting closer to retirement and it's like you've got a runway there that you need to make work. For younger people, you're probably making big life decisions like starting a family, getting into the property market, having kids, and knowing what your numbers are and how much room you've got, not just today, but 6 months from now or 3 years from now, when you're making these 10 or 20-year decisions. Very, very powerful and allows you to really optimise what you're doing and make the most of the money that you've actually got.
And the cost of advice is tax deductible as well, isn't it?
That's right. The ATO have changed their rules recently to make it easier and more accessible for people as well. So that can definitely help the tax time.
Bonus. Ben Nash, good to see you.